A very good afternoon to all our participants. We thank you for joining us on this special webinar on recent change in withholding tax rate, impact on foreign companies, jointly presented by Taxsutra and Nexdigm. Our speakers for today's session are Mr. Maulik Doshi and Mr. Nishit Parikh. With over 2 decades of experience, Maulik is the Deputy Managing Director, Global Transfer Pricing and International Tax at Nexdigm. He has experience across cross-border investment structuring, contract structuring, taxation of digital transactions, BEPS advisory, global M&A and restructurings, PE, and much more. He advises multinational corporations on Indian and foreign transfer pricing rules, including planning, litigation, advanced pricing agreements, and contemporaneous documentation studies. He is also a member of the International Tax Committee and was chairing the Global Transfer Pricing Business Group at Nexia. He has authored various thought leadership articles in India as well as international print media on a wide range of tax-related topics. He has also been recognized as a highly ranked practitioner by Euromoney's transfer pricing expert guides. Our next speaker, Nishit, has over 14 years of experience advising several Indian and international corporates on matters relating to international tax, FEMA, and structuring of inbound and outbound investment. He has extensive experience in areas pertaining to income tax, international tax treaty provisions, and FEMA. He also manages various tax technology initiatives and products which have helped MNCs to manage their compliance process efficiently. He is also a various speaker on various international tax and regulatory topics at various industry forums, including the CTC, ICI, bilateral chambers, and trade bodies. Before I hand it over to Maulik, I would like to take the opportunity to apprise all of you that in the last 10 minutes of the session, we will host a dedicated question and answer session. For this, you may post your queries in the Zoom chat box. With this, I now hand it over to Maulik.
Thank you. Thank you so much, Tanaya, and thanks to Taxsutra for kind of having us present our views on this very important change that came as a surprise when the finance bill was getting passed in the parliament. What we're going to go today is kind of talk about the change in section 115A on the withholding taxes on foreign payments, certain foreign payments, and what are the consequences for it, how it interplays, and more importantly, what are the implications for the companies making the payment from India, what are the implications for foreign companies with respect to their tax filings in India. So we're going to discuss all of this in the webinar today. We are also going to talk about how the transfer pricing compliances would be handled in scenarios where foreign companies earning income from India. This change kind of was sudden and surprise. We kind of were not expecting it because it was not a part of the finance bill. The government's lead down policy is consistency, right? The government has time and again said that they want to provide an environment of certainty, an environment of consistency. This change, especially given that there is no public consultation, there was no time given for people to react, was something which is kind of ironical to the government's stand. It was brought about only when the passage of the bill was undertaken by the Lok Sabha and the Rajya Sabha. When we were looking at some of the amendments that were tabled at the time of passage of the bill, and when I was looking at this, there was a change in 115A, and for people who have read finance bills or people who have kind of seen these changes in the amendments in the finance bill, the wording just kind of mentions that in place of 10 is replaced by 20, right? So something like that is just mentioned, and at the first blush, it was very difficult to digest that there could be a change in the withholding tax rate for royalty or fees for technical services. It's a huge change. It's a big change, both from a revenue perspective, from a garnering the revenue perspective, as well as from foreign companies doing businesses with India. And therefore, no one had expected that this change would come in at the last moment while passing the bill, and not kind of at the time of the introduction of bill itself. But nevertheless, the finance bill got passed amidst in Lok Sabha and Rajya Sabha. Unfortunately, there was not a proper discussion on the finance bill, and therefore we would never come to know what was the rationale or what was the thought process of the government in terms of increasing these rates from 10% to 20%. I don't think so. The memorandum explaining the finance bill, which was where this provision was not there, would have anything. So unless the government comes out with a detailed explanation in terms of what prompted the government to make this change, it will be very difficult. A discussion, a debate in Lok Sabha would have really enabled us to understand the nuances and the government thought process, but that's as of now absent, and therefore we are unaware of it. Now let's look at what's the history of this the royalty or FTS, withholding tax rate. These are the two categories where a significant amount of payments are being made by Indian companies either to their foreign affiliates or to their foreign vendors, and therefore it's important to understand how this withholding tax rate over the years have changed. So we were in that decade from 1976 to 2006. That 4 decades were kind of, by and large, we were either between 10% to, sorry, from 20% to 40% tax rate. So the rate for withholding was as 30% or 40% during that 70s and 80s. It was in 2006 that for the first time the withholding tax was reduced to 10%, and it was a surprise at that point in time also, because the 10% rate under the Indian domestic law was also lower than some of the tax treaties like US and UK, and therefore it was a very welcome move when the rate reduction happened in 2006. This prevailed up to 2013, although in between, in 2010, the government made an amendment to and brought in section 206AA, where they provided for penal tax rate of withholding tax rate of 20% if the foreign company does not have a permanent account number. So by and large, while the rate under the act was reduced to 10%, but because of this 206AA amendment in 2010, the penal rate of 20% kicked in, and at least for a couple of years, till the time every foreign company started to get hang of what this permanent account number is, what are the compliances, etc., the penal rate was prevailing on some of the remittances. In 2013, I remember the finance minister then, Mr. Chidambaram, had introduced, then the rate had increased to 25%. Again, this was a budget prior to the general elections, and possibly one of the reasons could be to increase the revenue flow to the government so that they can use for spending on budgetary allocations. But there was a surprise, again increasing to 25%. The new government again reduced it to 10%. So we saw a little bit of flip-flop between 2013 to 2015. But since 2015, the rate was constant at 10% till the current year in 2023, when the Finance Act was getting passed and Finance Act was getting legislated. It has now increased to 20% with effect from 1st of April 2023. So we've kind of seen quite a bit of changes in terms of the rate. We were hoping that it would remain consistent. In fact, there was no discussion on this aspect, and therefore this change that was introduced in 2023 was a sudden change. Now, how does it impact? Because a lot of Indian tax treaties, especially with European nations, with some of the Asia Pacific countries, etc., still have a withholding tax rate of 10% for royalty or FTS, and therefore, how does this really impact in terms of the overall scheme? Let's understand that a lot of these changes are driven not in isolation, but once you start putting together all of those changes combined, you'll realize that how the treaty rate becomes important, what kind of documentation is required to kind of take the treaty rate, and what are the implications if you are not able to take the tax treaty benefit. So let's understand the changes in the withholding tax rate. So there is no change in the dividend tax in the 2023 budget. Once the 2020 budget amendment came, where they brought dividend to tax in the hands of shareholders, the rate was provided as 20%. That has still remained 20%. But the rate with respect to royalty and FTVS, which was under 115A 10% for period prior to 31st March 2023, will now become 20% from 1st of April 2023. And the interest rate again has not undergone a significant change. It has remained between 5% and in some cases 20%. But There are a few changes in the interest rate, which we'll deal with it in our presentation later, especially with respect to foreign currency borrowings and foreign currency bonds. Now, against each of these items, if you see most of the treaty rates, most of the treaty rates are lower, except if you see royalty and fees for technical services. In two of the major trading partners that India has, which is US and UK, the treaty rate is 15% for royalty and FTS. So except for these two instances, in most of the other cases, the treaty rate is lower than what is currently under the Act, which is the 20% rate. Now, even if with respect to royalty and FTS, one important part to kind of understand is that while the US and UK treaty rates are higher, the scope and the definition of royalty or fees for included services is narrower, and that therefore to that extent, there is a benefit already available in claiming the treaty rate, not only from a rate perspective but also from a scope perspective. Now, we all know that as per section 90 subsection 2, a non-resident can opt for the tax treaty rate or the Domestic Income Tax Act, whichever is more beneficial. And so what was happening prior to 31st March 2023 was that we saw in many cases that while the domestic tax rate was 10%, the treaty rate was 10%. And obviously you add surcharge and cess to the domestic tax rate and it increases to say 10.92%. Still a lot of foreign companies were opting for domestic law because if you go for a tax treaty, then you need to produce all the kind of documentation, you have to file a tax return. So a lot of those things were required. And to get away from all of the hassle, especially if the amounts are not significant, they used to be governed by the domestic law with 10.91%. Now, to avail this tax treaty benefit, subsection 90, subsection 4 and subsection 5 provides that you need a tax treaty to kind of a tax residency certificate and a Form 10F for kind of claiming exemption under or claiming benefit under the tax treaty. I also mentioned at the start that there was a section introduced with respect to not having a permanent account number and a penal tax rate kicking in 206AA, which has now in some sense become redundant because your domestic tax law rate itself has become 20%, and therefore to the extent unless you are taking a tax treaty benefit, 206AA now becomes redundant. So let's understand how do this tax treaty benefit come into picture, because now tax treaty benefit would be playing a very important role. Availing tax treaty exemption or benefit it would become more critical for foreign companies that are doing businesses with India. So before we go into the what kind of documentation, etc., is required, one has to really see what are the points that one needs to consider for tax treaty benefit, right? So we saw multilateral instruments being India signing the multilateral instrument and a lot of other countries becoming a part of MLI, and therefore the tax treaty itself got revised with the provisions of multilateral instruments. So now any tax treaty one has to read alongside MLI, and therefore there are principal purpose test or simplified limitation of benefit test under the tax treaty. So one has to comply with those tests, then only the tax treaty benefits are available. So one has to really see whether, first of all, whether the tax treaty that I am concerned with, which is the matter of subject matter of discussion, whether that treaty is covered by multilateral instrument, and if yes, whether I am complying with the principal purpose test or simplified limitation of benefit test, depending on the coverage of the tax treaty. The second part is basically that you need to have documentation in place to ensure that your tax treaty benefits are not denied, which is basically your tax residency certificate, your beneficial ownership, your 10F, and we'll discuss this documentation in a little bit detail because that's the core of our webinar today. The third and important part is that if once you're getting a tax treaty benefit, you have to see not only the rate under the tax treaty, but whether there is a most favored nation clause with that respect to that tax treaty, and the withholding tax rate can be further reduced through the MFN clause, through a beneficial tax treaty that India has entered into subsequently, and whether the benefits under MFN clause can be passed on. Now, obviously, there is a significant amount of controversy with respect to the MFN clause with the recent CBDT circular, and whether the MFN clause automatically applies the date of entering into the treaty with the third party. All of those are questions, and some of these are open before the Supreme Court. And once we hear from the Supreme Court, it will be the law of the land, and then possibly the controversy will come to an end. Another important aspect is that under the Indian domestic law, general anti-avoidance regulations, GAR would override the tax treaty benefit, and therefore one has to be really careful in kind of providing the tax treaty benefit, and whether the tax treaty benefits are with respect to a tax arrangement or a tax planning exercise, and therefore can tax treaty benefit be denied. One has to be really kind of cognizance of this fact, and one has to really evaluate this part. Now, like I mentioned, to avail the tax treaty benefit, one has to be really having the certain documentation. We have tax residency certificate, which is provided as per section 90 subsection 4, that is required to be furnished by the non-resident to substantiate that he is a tax resident of the other country, and therefore is available, and therefore the tax treaty is available to him. He can take shelter under the tax treaty. Thereafter, section 90 subsection 5 was introduced, where there was a requirement to file form 10F. And in this case, the form 10F was required where the tax residency certificate does not provide certain information which the Indian tax authorities wanted. So as per Rule 21AB, if certain information like is not available on the face of the tax residency certificate, then form 10F is required to be filed by the recipient, by the vendor, and provided to the Indian payer. And as a matter of practice, we do kind of take into the fact that the foreign company does not have a permanent establishment or a business connection in India, especially to rule out higher withholding of 40%, or to rule out net basis versus gross basis of taxation. So kind of one also takes a no PE declaration once the non-resident is claiming any tax treaty benefit. Now, the most critical part of this entire documentation is the TRC, and we have kind of had case laws where, including Azadi Bacha, which says that once a TRC is there, the tax treaty benefits should be provided. But really, what is this TRC, and kind of can a tax treaty benefit be provided without a tax residency certificate also? So basically, the basic form and the substance of TRC is that it's a certificate from the tax authorities of the overseas country, which certifies that the foreign company in question is a tax resident in that country. It generally includes the name of the non-resident, it includes the period of residency, it includes the country in which the person is resident. Now, we had two interesting case laws, one in case of Ahmedabad Tribunal from SCAPS Industries, which provide that the requirement to provide TRC has come from 90 subsection 4, and therefore it does not override 90 subsection 2, because 90 neither of them has a non-obstant clause. So as long as 90 subsection 2 is fulfilled, which is the foreign company is there is a tax treaty with the foreign country, then the tax treaty benefit should be available. Treaty protection cannot be denied that TRC is merely on the ground that TRC is not available, and there should be some sufficient or reasonable evidence in some form or the other to satisfy that the company in question is a resident of that country. So it need not be restricted to TRC. Any kind of documentation or any kind of evidence to suggest that the company is a resident of that country should be good enough, is what the Ahmedabad Tribunal has held. Obviously, this case may be lying before the High Court. We have not heard further in terms of what has happened to that. We had another case in case of Srinivasa Reddy, where the facts were slightly different, where the taxpayer had made several attempts to get the TRC from the foreign country, but it was not available. It was not possible for him to get the TRC, and therefore the tribunal ruled that taxpayer cannot be penalized for an impossible task, and treaty actually overrides the substance of subsection 90 subsection 2 is that treaty actually overrides the act, and therefore the income is exempt under the treaty. Although TRC is mandatory as per 90 subsection 4, it cannot mean that his absence will result in a treaty denial. So these are the two interesting case laws which have really provided that the TRC is not really a mandatory document, as long as the treaty benefit cannot be denied merely because a TRC is not available. Now, I know it's very difficult to take this stand in practice, because your assessing officer is never going to accept this. So you have to be really ready for litigation, and there has to be some facts kind of supporting you. Like in the other case, it was difficult to obtain, or there should be some other document substantiating that the non-resident or the foreign company is a resident of that country. So, but in scenarios where these facts are there, then these two judgments can be useful. Then we had 90 subsection 4, which introduced the requirement for Form 10F. That is again for the purpose of claiming benefit under the tax treaty in cases where tax residency certificate does not have all the specified information. What are the specified information that Rule 21AB requires? Is basically the status of the company, the nationality, the tax identification number, the tax period, and the address of that thing. Now, we have seen several countries, like majority of the countries do not have all this information when the tax authorities overseas provide for TRC. And therefore, 10F was kind of, by and large, became a normal document. Like it became a document to be attached along with TRC for almost all countries, except for a few countries like Netherlands, Mauritius, Nepal, Sri Lanka, Egypt, and Bangladesh, which you have mentioned. Pretty much all other countries really kind of did not have these details, and therefore a TRC was always followed by a 10F. Now also TRC formats keep on kind of undergoing changes. So one needs to see this list is not sacrosanct. More countries can be added to this list, or some countries may go out because they may change their TRC formats in their home countries. So one is to really see that this information which is required as per Rule 21AB, whether that is available on the face of TRC or not. And if it's not available, then Form 10F in some sense becomes compulsory. Then we had the no PE declaration, which we kind of mentioned is typically to kind of ensure that the non-resident does not have a permanent establishment in India as per the treaty or a business connection as per the act. Generally, we also cover the beneficial ownership of beneficial owner of the income in some of the declarations. Now, what happens if there's no PE? Because if you do not have a no PE declaration, then kind of the question arises whether the foreign company has a PE and therefore the withholding tax would be on net basis, or a higher withholding tax of 40% on gross basis could apply. So this no PE certification or no PE declaration becomes important. Now, one has to be really careful, like because we have seen so many instances in practical life that the foreign company just merely signs and gives the no PE declaration. We had one instance where a Singapore-based company, in fact, it was an architectural company that had issued a no PE declaration to its Indian customer, stating that, and it was kind of like generally how the Indian customer would have sent it, they would have filled in, they would have signed and sent it back to them. It was on their letterhead, and on the letterhead below, the letterhead format had kind of offices. In the offices, it was written Mumbai, Delhi, Bangalore, and some of the overseas locations like Tokyo, Malaysia, etc. Right? So they had writing there no PE, but there are 3 locations in India. So this was the kind. So one has to be really careful in terms of how you take the no PE declarations. There are other instances that came up in our kind of practical life, is that we know as a matter of fact that foreign company employees are in India for some implementation work or for some supervisory activity, and those employees kind of keep on coming regularly traveling to India, and they are at your premises, you being the payer of that of the technical services of the royalty. They are at your premises. Pretty much you are aware of the number of days they are staying in India, number of days they are exceeding the threshold under the tax treaty. Yet the foreign company gives a no PE declaration and the Indian company relies on it. So the question is that in these cases, what is the onus on the Indian payer? Would they rely merely on the declaration, or they should do a check beyond that and see whether actually there is a PE or no PE, especially in scenarios that I mentioned where it is quite visible to the Indian deductor in terms of what the presence of foreign employees in India is. Now, this was all fine. This was still working well in terms of kind of the foreign company used to provide TRC, 10F declarations, etc., sign no PE declarations, etc. Until 16th of July 2022, when CBDT came out with a circular where it required that this Form 10F has to be filed in electronic format. That circular of 16 July 2022 had a number of other forms that were made electronic, from manual or physical, that were made electronic. And it contained one of this form as Form 10F. This was under Rule 131, which empowers CBDT to specify any forms that needs to be filed electronically. Now, what has happened after this is that if a non-resident has to file a Form 10F electronically, they are compulsorily required to create a login on the income tax portal for generating 10F electronically. Now, to create a login on income tax portal, they need to have a permanent account number. They cannot create or they cannot generate an electronic 10F without a permanent account number or without an income tax login. So in some sense, permanent account number was indirectly mandated or indirectly required for generating an electronic 10F. Now, obviously, a lot of non-residents did not have a permanent account number. They had to kind of opt in either a permanent account number or opt in a DSC. They will also require a DSC to file this form 10F electronically. And once they have a permanent account number, then kind of the tax authorities can kind of actually see whether against that permanent account number, whether the tax returns are being filed, TP compliances are being undertaken on a year-to-year basis or not. And if there are non-compliances, the notices can be sent. Now, till the time this was 10, the Indian income tax rate was 10%, which was from July 2022 onwards. In the financial year 2023, it was still 10%. It was still okay because some of the companies were foreign companies especially saying that rather than getting a permanent account number and creating an income tax login, I might as well be governed by Income Tax Act and kind of get away with 10.92% rather than doing all the compliances in India. But now with respect to this change under 115 that the Finance Act brought in, it's going to be very important to access treaty, and therefore this 10F becomes important. Now, obviously, there was a lot of hue and cry, a lot of discussions and representations being made to the government saying that this electronic filing of 10F for foreign companies, it's kind of a requirement which is come out of the blue. Foreign companies do not have a permanent account number, and it's very difficult for Indian customer or Indian payer to explain their foreign vendor why all these compliances are required, why they need to register with the Indian tax authorities. In such case, so government first on 12th of December 2022 came out with a notification which had extended the time limit for allowing manual or physical form 10F till 31st of March 2023. So, but that circular came with a rider. That circular said that only non-residents not having a permanent account number or not required to have a permanent account number as per the Indian Income Tax Act and rules will be given this relaxation that they can file a physical form 10F till 31st March 2023. Now, this has been further extended by a notification dated 28th March to 30th September 2023. So the same relaxation which was there has now been extended to 30th September 2023. So again, non-residents not having a permanent account number or not required to have a permanent account number can provide a physical or a manual form 10F till 30th September 2023. Now, this circular, when it was kind of brought in, had also a lot of kind of question like not required to obtain permanent account number. What does that mean? Can it be said that all non-residents falling under 139A clause 1 and 2 are required to obtain PAN? Because if you read that two clauses, they are very wide. Anyone doing any business really literally, whether in India or not in India, literally gets covered under that section. So to that extent, what does this clause not required to obtain PAN mean? What are the categories of foreign taxpayers that are required to obtain PAN as per Indian rules? There is not absolute clarity on that. Can I kind of rely on the declaration from the non-resident that I am not required to obtain PAN in India for the purpose of accepting a manual form 10F, right? Because it's very difficult for me as a deductor to know whether a non-resident is required or not required to obtain PAN. And therefore, can I rely on a declaration from that they do not have a permanent account number and they are not required to also have a permanent account number? And last and most important is that whether, again, this is a procedural requirement under the Indian income tax law. By not fulfilling this, can it really override the tax treaty benefit? Can the tax treaty benefits be denied? And again, apart from the two case laws on the TRC we discussed, there were case laws of Serum Institute and Denisco, which the tribunal held that because of the mere non-fulfilling of a procedural requirement under the Indian domestic law cannot really deny the tax treaty benefit. So these case laws are there, but accessing these case laws, relying on these case laws is going to be a challenge because it's an uphill task in terms of litigation. And the question is on deductor because the litigation will come to the deductor here. And one has to really take a call in terms of what kind of risk appetite and what kind of litigation appetite does one have to kind of really take this up. So in essence, if there are no tax treaty benefits, now the law is very clear. The tax rate is 20% plus surcharge and cess goes up to 21.84%. If all tax treaty benefits are provided, including an electronic 10F, then the rate as per tax treaty would be applicable right now till 30th September and after 30th September also, because you have an electronic 10F. If all tax treaty benefits are provided, but 10F is provided in a manual form, because the foreign company does not have a permanent account number, till 30th September, the tax treaty benefit would be available. But after 1st of October, based on the current circular, the rate would be, the tax treaty benefit would be denied, and therefore domestic law rate, which is 21.84%, would kick in. And if the non-resident does not have a permanent account number, but provides information under Rule 10 BC, sorry, Rule 37 BC, then in my view, still 21.84 benefit would be available, because TRC and 10F becomes a very important document to avail the tax treaty benefit. Without electronic 10F or manual till 30th September, the tax treaty benefit would not be available. So with this background, one has to really consider, especially there are cases of gross-up arrangements with the non-resident vendors. We have seen that in case of gross-up arrangements, it's very difficult to obtain treaty, because the vendor is really not concerned with the tax rate in India. They really don't take any effort to give you the documentation. So one has to really negotiate with each and every vendor to see what can be there. And for non-residents also, where they are not gross-up cases, they have to provide appropriate documentation so that the lower rates can be availed. You also need to understand that if the tax rate is deducted not as per the tax treaty, but as per the Indian Income Tax Act, for the non-resident foreign company, it would be difficult to obtain credit in the home country for the entire taxes. They can opt in only with respect to the tax rate mentioned in the tax treaty, and therefore the balance taxes which are there may be lost, and it would be a tax cost for the company. So these are some of the scenarios that really make a difference in terms of the changes with respect to 115A. We'll deal with some of the more practical cases and kind of how does one go about with some of these changes practically. I'll ask my colleague Nishit to take it over from here.
Nishit, you're on mute.
Tanaya, can you enable me to share my screen?
Sure.
Your presentation. Yeah, is my screen visible?
Yes, Nishit.
Yeah. So now we will also look at some of the important changes or updates which not necessarily came as an amendment, but more were like silent changes which happened because of no action taken by the government. So one was on the significant economic presence, which came around 2021-22, the applicability started. The threshold limits which were not prescribed came around in May 2021. So technically, for all practical purposes, significant economic presence provisions are already there under the law. And the law, while the intention of introducing significant economic presence regulation was to tax digital transactions in India, because it came out of that BEPS action plan. But unfortunately, while drafting the language, there is no mention of digital goods per se in the law itself. And even if you read the memorandum which introduced the SEP provision, it talks about the genesis of introducing this was a widespread digital economy, which is not getting captured. But when the law and the language came in, there was no mention of the word digital. So unfortunately, now if you look at the SEP provisions, it covers any transactions in respect of goods, services, or property done by a non-resident in India, and includes provision of download of data or software in India, plus systematic and continuous soliciting of business through use of data through digital means. The limits are pretty small. So there is a limit of 2 crores for transaction and around 3 lakh for the users. So in a way, what it entails that for a foreign company which is selling goods to an Indian company, the complication now arises is that as of today or till 2021, March 21, the companies were taking a position that the income from sale of goods in India is exempt under the provisions of domestic tax laws, and hence probably taking a position that I don't have a permanent establishment in India or a business connection in India. The sale is concluded outside of India and hence not liable to tax in India. And that's because of that not required to do any compliances. However, now the legal position has changed. The moment the transaction threshold on sale of goods exceed 2 crore rupees in India, technically they would have a business connection in India in form of a significant economic presence. And then they cannot give you a declaration saying that I don't have a business connection in India. So only fallback for them is to go to the tax treaty provisions. The moment they want to go to the tax treaty provisions, they would have to again get into the documentation which Maulik kind of elaborated in earlier part of the presentation, give a TRC, give a 10F, which now is manual, but post 30th of September, it will become online. So they will have to obtain a PAN even for a thing like a sale of goods, which was kind of unheard of. Currently, while this is applicable from 2021 onwards, we've seen a lot of companies not actually doing or taking any action on this. But there are two critical things which will come out in future. Once the bankers start asking 15 CB for sale of goods, then it could become tricky for Indian payers, because then they will have to certify the transaction. Currently, it is going under the normal payment route and hence nobody is noticing it. Second, foreign companies, if they are filing tax return in India, they have to report as a compulsory question in the tax return whether they have a SEP in India or not. If yes, what is the quantum of transactions or the value of transactions they are undertaking in India. While this is something which is not come on radar of many companies, but potentially this could throw up compliance challenges and also difficult discussion with your vendors and counterparts in foreign countries, explaining to them why they need to file a return or give you a TRC for something as basic as a sale of good in India. Second, there were a couple of beneficial provisions under the law, mainly for interest payments. One was interest payments on foreign currency loan, popularly known as ECBs, borrowed under a loan agreement which is entered on or before 30th of June 2023. It was almost kind of assumed that India needs that foreign currency to come to India, and hence this limit would be extended. But the budget was silent on this, and hence now any ECB loans which an Indian company is taking post 30th of June 2023 would again require determination of whether the tax treaty is beneficial or the local law is beneficial. Local law rate will go up to 21.84%. And there are treaties like Mauritius and others where interest can be taxed at 7.5%, or other treaties generally have 10 or 15% tax rate. So it is likely that for ECB interest payments also, companies would have to fall back on tax treaties. And that's where again the entire documentation requirement would come into picture. Second, beneficial tax rate of 5% was available to FP and QFIs on debentures and bonds. Obviously, there was a controversy there whether debentures per se are considered as bonds or not. But by and large, the jurisprudence is in favor of the taxpayer, whereby it has been held that yes, Indian company debentures can be considered as rupee denominated bonds, and hence benefit of 5% is available. So this is the wordings of this section are slightly different than the wordings of the 194 LC section. Here it talks about interest paid after June 2023. So there is no protection. But in 194 LC, our view is that if the loan is taken prior to 30th June 2023, the benefit of 5% would continue. But here any payment after 30th of June 2023 of interest would entail a higher withholding tax rate and higher taxability for the FPI and the QFIs in India. So this could get complicated in coming days. That is my view. Now coming to, okay, so this amendment has happened. Now we will have to deduct higher taxes on the foreign company if they don't give the document, or if they give document, we'll have to give them the tax treaty benefit. But the unintended consequence or kind of implication for the foreign company is that if you look at the construct of our section 139, which talks about obligation to file a tax return in India, it broadly says that it's very wide. It says that every foreign company or every company, even not, it does not even mention foreign company. It says every company is required to file a tax return in India. And logically, foreign company also would be included as any company. So if you look at a very, very logical interpretation, then any foreign company earning income from India would be required to file a tax return in India. Again, the view was that if there is an exemption provided by the local laws itself, so if a foreign company is getting certain exemption under section 10 of the act, or it is not taxable because of the charging provisions not being applicable, so like sale of goods in earlier times, like I mentioned, then the position was that we will not be required, or a foreign company will not be required to file a tax return in India. In addition to that, section 115A, which talks about taxability of FTS, royalty, interest, and other income of a foreign company, specifically granted an exemption from tax return filing obligation for a foreign company if they are okay to bear taxes as per the Indian local laws, which was not much of a problem as most of the countries' tax rate was 15% under the treaty or 10%. So either there was an incremental cost of 0.92%, or there was actually a saving by going under the local laws, and they were taking that benefit, and there was no filing of tax return done. Obviously, there also the position was clear that the exemption was provided only for the tax return filing and not necessarily for compliance under transfer pricing. But we had seen that since there was an exemption for non-filing of tax return, people were actually not taking a permanent account number itself, giving a TRC and a declaration under 37 BC, and not filing any tax return in India, and correspondingly not filing transfer pricing report, that is a Form 3CB in India as well. So now with SEP coming in and the rate change, many companies would want to adopt or go under the tax treaty provisions. And that's where possibly they may be required to file a tax return in India. And also tracking of those people would become easier with the PAN being available, PAN being quoted in the withholding tax return, because indirectly by introduction of online Form 10F, the PAN would be kind of available with everybody who wants to take this benefit. And hence the tracking of these non-filers would become easier for the tax department. So now, keeping aside transfer pricing for a moment, if I have to just summarize that what is a case and what is a compliance requirement. So if your foreign vendor, or if you are a foreign company, you are having any FTS royalty income in India, and you are okay to bear a tax of 21.84% as per the local laws of India, then technically as per 115A, there is no requirement of filing a tax return in India, and practically people may adopt a position of not even obtaining a PAN in India. Obviously, if there is a related party transaction, then from a transfer pricing perspective, we will have to evaluate the risk, whether for that a PAN needs to be obtained and only a 3CB needs to be filed and tax return need not be filed. Second situation, royalty FTS income under section 115A, but you want to take the benefit of a tax treaty. Assuming you have all the documents like online 10F, NOPI and all of that, and you are taking a tax treaty benefit, then technically for the foreign company, a tax return filing in India would be required, and also technically obtaining a permanent account number in India would be required. Same way you have interest income, dividend income, royalty and FTS income. You are, for majority part of the income, you are going under the act, or all the income you are going under the act, then no compliance requirement. But if for one of the income also you are taking a tax treaty benefit, then technically you will have to file a tax return in India and obtain a PAN in India. Say a scenario where you don't have any service income, but you have a business income, that is sale of goods. If your income is less than 2 crores in India, in aggregate, after looking at all your business in India, then possible to adopt a position that exemption is still available under the act, and hence no tax return filing requirement, and hence no obligation to obtain a permanent account number. However, if your income is more than 2 crores, then you will definitely have a SEP in India. Whether you would be conclusively able to prove that nothing is attributable, no income is attributable to that SEP, then possibly you can still go under the act. I don't know whether any deductor will be ready to listen to you, then nothing is attributable to the Indian sale leg. If he agrees, then possibly to say no withholding under the act, but very risky for an Indian deductor to take such a position. Otherwise, you need to fall back on the tax treaty. In that case, you will have to again file a tax return, as you are claiming a tax treaty benefit. So you'll have to give an opportunity to the tax department to examine whether you are eligible to a tax treaty benefit or not, and accordingly do your compliances in India. Then coming to compliance under transfer pricing regulations. So at a very high level, if you look at construct of section 92E, it says that every international transaction entered into by a company with its associated enterprise has to be reported in a Form 3CEB. So that implies that all transactions entered by a foreign company with a related party are required to be reported. So at a very conservative level and a very literal reading of the provisions, all transactions, whatever transaction you do with your related party needs to be reported in the 3CEB of the Indian company as well as of the foreign company. So both the companies has to do compliances in India. Now, if we want to break it down into various different types of transactions, say you are earning income which is taxable in India, like royalty, FTS, interest, dividend income, or income arising and which is attributable to a permanent establishment in India. Then the view is that yes, if you are earning taxable income, then there is no getaway for you. You need to report the transaction, because for non-reporting, the penalties under transfer pricing are very high. So here again, for specific items, somebody may ask me a question that for fees for technical services, if somebody is taking benefit of make available, can I say there is no income taxable in India and hence I can take a position that I need not report anything? So that is one position, but it would be very aggressive. So ideally, we recommend that on a conservative basis, for those kind of cases, it should be reported. For dividend income, again, there is a divided view, because typically for a transfer pricing transaction, you need two parties. Two parties need to agree on a price and whether that price is at an arm's length or not. But in dividend, the foreign company or the shareholder has no control over what dividend Indian company would declare. So by and large, it's a one-way transaction where an Indian company decides the amount of dividend depending on its profit situation and its future business plans and declares a dividend. So there, potentially people have tried to construct an argument that here there is no question of applying transfer pricing provision, because there is no question of benchmarking this transaction, because there is not a mutual agreed transaction between two parties. But again, depending on the quantum and all, you need to kind of look at the risk and evaluate whether you want to do a compliance or not in India. Now coming to income which are exempt. So if you have income from sale of goods and you don't have a PE or SAP in India, then relying on that Vodafone and Shell decisions which are there in context of capital contribution, a view may be taken that this is not required to be reported by the foreign company. And if you only have this transaction, probably not required to file a 3CB. Similarly, for recovery of expenses which purely fall under the category of reimbursement, Another tricky situation comes is exempt capital gains under the treaty. So like Mauritius Treaty, Singapore Treaty has grandfathering provisions. And if some FPI or a large fund has earned a big capital gain in India and it is claiming an exemption under the tax return, then whether it needs to be reported under a 3CB or not. So while potentially argument can be taken that it is not taxable, so not required to be reported, but that would be a very, very aggressive view. If you are any which ways doing a compliance on the tax return side, better to report it in the 3CB as well. Again, on expenditure, we have seen practically most of the company taking a position that if I'm making only a cost plus payment or an interest payment or a guarantee fee payment to my Indian parent or an Indian cost plus entity, then by and large, they are not complying, and we've not seen kind of any concern or any kind of jurisprudence raised by the tax authorities that they should also do compliances for this expenditure, because ultimately they are not claiming that expenditure. They are not claiming any expenditure in India. Similarly, if you are having business expenses, you have a P in India and you are claiming those business expenditure, then definitely you need to comply with the transfer pricing provisions in India as well. So as a way forward for non-resident, first, they need to kind of start obtaining PAN wherever they want to kind of get tax treaty benefit. They need to start obtaining PAN and start collating all the required documents which their Indian vendors would require to ensure that they are not faced with a higher withholding of 21.84% starting 1st of October 2023. If they don't do that, 21.84% would be there. Also, declarations, like Maulik mentioned, that as Indian vendor, you should also carefully look at the declaration. If you are doing a, say, if you yourself are purchasing goods worth more than 2 crores from a party and he's giving you a declaration that he does not have an SEP in India, then blindly accepting that declaration also would not make sense. For you will have to question them and talk to them that why they are giving such a declaration. Also, non-resident would have to evaluate their income and taxability in India and prepare for the compliances which will go with obtaining a PAN in India. Also, from an Indian company perspective, from a deductor's perspective, they need to look at talking to their vendors, starting to communicate with their vendors right now, that if they are not able to provide requisite documents by a particular timeline, say 1st of October, or they are not able to provide online Form 10F by 1st of October, then there would be a higher withholding. So I'm saying that even if you are planning to take certain aggressive position that no, 10F is an additional requirement, we will go by the Genesis argument, but you should create a genuine case for yourself that we requested it for 5 times, we did not get, and it was a tax protected contract, so we cannot suffer a higher cost, and we did all our efforts. So it should not be that you straight away take the position of not saying that 10F, online 10F is ultra vires or not applicable for XYZ reason. The documentation and the effort on obtaining that document should be clearly documented. Talking about Indian companies first, with these changes, it is very important to align with your business teams. It may be possible that in various contracts, the negotiation is happening by the business teams on the pricing, on the tax terms. You should, with these changes, be talking to your business team and either aligning them that what would be the basic minimum requirements, or giving them a rate chart that if this is what the customer is saying, then, or sorry, this is what the vendor is saying, then we will have to tell them this is what the tax rate is. Or get involved yourself in terms of discussing the tax clauses while the negotiation is taking place. Governance for collection of documents. So in my experience, we've seen that lot of companies have kind of put down strict guidelines as to with their vendors that if this is what you're going to give me, this is the tax rate. If this is not available, this is what I'm going to do. So, and also we've seen that a lot of times the voice or the governance is coming from the top level to the bottom level that this is what you need to do. And it is not flowing other way around. So involving your top management, decision makers on the implications and the impact becomes relevant, so that they will also be party to the discussions and probably force upon to the vendors that this is what is the law of the land and probably you may have to comply with it. Second, we've seen that in many cases, lot of processing of the payments is done by the accounts payable team or the finance team. So it is important for the tax team to align with the new requirements with the AP teams. Also important to have the right partner, chartered accountant, who is validating all the documents, verifying the tax positions, and not merely approving what is being said by the company, because that kind of acts as a maker checker for the companies, and also potential risk are highlighted at the time of remittance so that appropriate action can be taken at the right point in time. Using of right tax technology products and tools where you can have a trail of the entire process, because all this would scrutinize 2 years, 3 years, 4 years down the line. And even if you are getting into reassessment, it may come even after 8 to 10 years. So having right set of documentation in place and right process to store the documents and retrieving those documents would become very, very critical. Second, for larger groups where a lot of foreign group companies are doing business with the Indian companies, would have to ensure that they talk to their foreign counterparts, tax heads in the respective countries, that if you want to avail lower tax rates in India, potentially there could be implications in terms of you filing tax returns, Form 3CB in India. So understanding their views, how they are looking at this compliance requirement in India, and also telling them that depending on the value of the transaction and the tax positions, there could be potential assessment, revenue audits which may happen. And after discussing all of these aspects, taking a position that whether they want to opt for tax treaty benefits or they want to continue under the Income Tax Act rate so that they don't have to file returns. So that alignment at this stage is very important, rather than going to them in next October and saying that this tax return has to be filed. We have been told you have to file. Aligning them, preparing them from right now, so that they are also part of the decision making, would be very relevant. So with this, we end our presentation, and thank you everyone for your patient listening. And Tanaya, over to you.
Thank you so much, Maulik and Nishit, for this presentation. We do have quite a few questions, to be honest. I'll take a couple of them. So the first question is, what about tax audit filing who are opting to take treaty benefit and are not eligible for the exemption under section 115A?
Yeah. Yeah, Tanya, sorry, can you repeat the question? Sorry.
Yeah, it says, what about tax audit filing who are opting to take treaty benefit and are not eligible for exemption under section 115A?
So, first of all, this is a gross basis taxation. So tax audit filing per se would not come in. There would not be a case where somebody is not eligible for a benefit under 115A versus being eligible for a treaty. So it would never be that he is eligible for a treaty benefit but not eligible for a beneficial rate under 115A.
Right. Shubham is asking, suppose SEP is triggered, but there is no PE in India. What will be the next steps? So will it be WHT or ROI?
So if SEP is triggered, but there is no permanent establishment in India under the tax treaty, then like I mentioned in my presentation, you need to obtain the tax treaty related documents from the foreign party. And that foreign party may potentially will have to file a tax return in India. But if if the no PE declaration is given, you may continue with the position of non-withholding.
Sure. Hitesh is asking, in case of a non-resident having a transaction value of more than rupees 2 crores and thereby resulting into SCP, will the declaration on no PE with Form 10F and TRC be sufficient?
Yes.
Okay. The next question is, a foreign company having no PE in India does IT services in India through Indian employees. So how are they going to be taxed?
So they are doing IT services in India through Indian employees. So I assume that in this case, there is no Indian entity. In that case, they will have to kind of first, the payments would be received by the foreign company. Then potentially they need to examine the PE risk on account of employees being in India without an entity. And second, if they are receiving the payment, Indian deductor will deduct the taxes while making the payment. But if you meant that they are operating through an Indian entity, then there is no question if the Indian entity is rendering services in India.
Sure. Rajesh is asking, filing of 3CEB has come into picture after recent amendments, or was it already a requirement prior to these amendments?
So so just to answer in short, yes, it was always a requirement. So even when the 115A relaxation for filing tax return was introduced, there was no corresponding exemption available from transfer pricing compliances. What we are trying to put across right now is that since because of online filing of 10F, a lot of foreign companies would be obtaining permanent account number in India, say post October, once this new notification, assuming there is no relaxation further after 1st of October, then the tracking by the tax department for the non-filers would become easier. Currently, tracking itself was difficult by the tax department. So now it becomes more apparent.
Sure. Another participant is asking, good evening, sir. When an Indian company is anyways filing Form 3CEB for international transactions with its AE, what is the purpose of the foreign company again filing Form 3CEB with respect to the same transaction with its Indian AE?
So the purpose we are also not able to understand. The idea is that legally speaking, both are different taxpayers and different assessees. And what, in fact, we have seen in many cases where the Indian companies Form 3CB, there is no adjustment done by the TPO, but in foreign companies case, there's an adjustment done saying that foreign company is charged less to the Indian company and therefore lesser income is brought to tax in India on account of withholding taxes or whatever, etc. So the objective is to treat both assessees separately and see and do the compliances with respect to both assessees and see the arm's length price scenario for both the assessees separately.
And also just to add, there have been cases where even recently the Indian tax authorities are not even agreeable to rely on the transfer pricing study report of the Indian entity for the foreign companies. They are saying that for foreign company, a separate transfer pricing study report has to be maintained. So even they are going to that extent.
Harsh is asking whether interest or royalty earned by a foreign company will be considered for computed SCP threshold or INR 2 crores.
So it is any transaction. So overall, your income, your means of foreign company's income from India would be considered. It does not kind of bifurcate. It is not specific to royalty or FTS. It says that any income from any services, goods, property, and it is very wide. So even the delayed payment charges or whatever interest you're talking about, all of that would have to be looked at in a cumulative manner.
Sure. Mahadev is asking if we have paid royalty from 1st April 2023, do we have to deduct withholding tax at 20% or treaty benefits can be applied?
Treaty benefits can be applied subject to availability of the documentation.
Okay. The next question is by Shubham. He says, if WHT rate as per DTA is beneficial and taken, is ROI filing mandatory?
Yes.
Yes. So if treaty benefit is taken, our view is that And logically, if you see, if you're taking a tax treaty benefit, how will the government actually analyze that whether you are eligible to a tax treaty benefit? Today, in order to avail a tax treaty benefit, we are seeing so many cases where the beneficial ownership is challenged, where the substance of a foreign entity is challenged. So all of that, unless you file a tax return, the tax authorities will not be able to examine. So technically, if you are earning an income and taking a benefit under the tax treaty, that's why the tax return filing is requirement. And our view is that this amendment more or less is also from that objective, because earlier nobody was kind of filing the tax return and taking that exemption. And probably that's why the thought process from the tax authority side was to increase this rate. So whoever actually wants to claim a lower rate will have to file a tax return.
Sure. Devanshi is asking, in case of import, is it compulsory to obtain the DTA documents from NR, even though there is tax treaty already available?
So for when you say tax treaty is available, means TRC is available. And like we discussed in the entire presentation, section 90 subsection 4 talks about obtaining a 10F. So if your TRC is available, which has all the details which is required as per rule 21AB, then probably you should not take any further declaration except the no PE declaration. But if that is not there, you will have to take the 10F as per the law, like I mentioned.
Sure. Basanta is asking, if the non-resident has not submitted electronic filing of 10F, will there be any tax implications in the hands of the payer?
So technically, if you look at it, first of all, that there is a relaxation up to 30th September, but very technically, it is a notified form which has to be filed electronically. So the moment you are not taking it, the form, in a very technical sense, somebody can say is an invalid form. The moment the form becomes invalid, you have not fulfilled the conditions of section 90, subsection 2 and subsection 4, and hence you were not eligible to grant the treaty benefit. And automatically that will result in a short deduction because TT access is not available. So it's a technical view. Obviously, like Maulik had highlighted in the presentation, there are possible legal positions where you can argue that it's a unilateral amendment by India. It should not affect the sovereign right of a foreign company to claim tax treaty benefits, which was agreed by two governments. There are decisions like Serum, Infosys BPO or Densico, where all these principles have been upheld. But then you will have to be prepared for fighting it out, at least till IT-80 or a high court level, to get some sort of relief.
Tanaya, there are, I think 2 or 3 people are asking questions on the transitional provision. What happens if the accrual is made on 31st March and payment is made after 31st March? So I thought we'll take that up. This does not affect anything for accrual made on 31st March, because section 195 provides that you need to deduct TDS at the time of accrual of payment, whichever is earlier. So the moment you accrue in the books of accounts on 31st of March, you deduct taxes based on rates prevailing on 31st of March, which is 10%, 10% plus surcharge and cess as per the Indian domestic law. And therefore, even if the payment is made after April, the 21% rate would not apply, and only the 10% rate, which was the based on accrual and tax deduction before 31st March, would apply. But if you do the accrual in April itself, then the new rate would apply, which will apply from 1st of April.
Okay, sure. Actually, we had received at least 68 questions. So, Maulik, how long can we go until, can we take maybe one or two?
We can continue for another 5 minutes or so. We can take a few 4 or 5 questions, maybe, because some of the questions I see are repeat, but maybe unique questions, something we can take it up.
Okay, sure. So one question by Aarti is, interest on foreign currency loan availed before 31st March 2023, will it continue for 5%?
Yes, so like I mentioned, our view is that if a loan agreement is signed on or before 30th of June 2023, the interest payments till the time this loan is continuing should get 5% benefit under section 194 LC.
Okay, Hitesh is asking, can a non-resident appoint an agent like a CA firm or a representative assessee to apply for Form 10F electronically by using the PAN of such an agent?
So I don't think so that should be possible, because the treaty benefits are being claimed by a foreign company, and I'm not sure how this is going to work, because the foreign company's PAN would be required.
Ritesh is asking, as on date, there is no provision on the portal to submit online Form 10F for AY 24-25. So, like, how do we proceed?
So that similar thing was there last year also, and after a few days raising grievance on the income tax side, it was immediately enabled. So if you are actually willing to file it online, you can just raise a grievance, and I'm sure that it would come in few days time.
And this is already being raised to through CBDT and top tax officials, and I think they are looking into it. They will enable it soon.
Okay. Neeraj is asking, under section 194 LC, is the condition of 30th June 2023 would apply to agreement or drawdown of loan?
So this is something probably we'll have to take it offline, and I will have to look at it, the exact facts, how the agreement is. But by and large, we will have to see the provision talks about the date of loan agreement. So by and large, even the drawdowns, in my personal view, it should not be a problem, but this is something we'll have to look at.
Okay. Jankhana is asking whether tax return filing and TP compliance be required in case of cost-to-cost reimbursement to overseas group company.
So on a reimbursement itself, there is a controversy. So there are decisions like CU inspection, which talks about what is a reimbursement nature, if it's a pure travel reimbursement or things like that. But if you have availed some services which is paid by your group company and you are reimbursing, then technically you need to look at whether if you were making directly payment to the third party, then whether there would have been a liability or not. If the answer is yes, then probably withholding would apply there as well, as per the decision of Bombay Tribunal in case of CU inspection. So reimbursement itself is a topic which is under a lot of litigation. But to answer the question, if it's a pure play reimbursement where there is no service element, then probably the view what the gentleman mentioned is correct. But if it is something of a service orientation, then the withholding aspects would have to be looked at.
Nishit, there's one more question on the surcharge. We mentioned a rate of 21.84%, but that's with after crossing a particular threshold, right? So below the threshold, it is 20.
Yeah. So we have spoken about the maximum rates right now for simplicity. So there is 2% surcharge and 5% surcharge, depending on the quantum involved.
Kushal is asking for withholding tax at 10.4% done on accrual in March 23. Can we file Form 15 CB in April 23 while making the payment certifying tax deducted at 10.4% as per the IT Act?
Yes, we can do that. Which is the question transitioning provision just I answered a few minutes back. We can do that.
Another question by Manish is, will the declaration from NR that they are not required to have PAN be a dependable document to allow the treaty benefit without obtaining online Form 10F?
So on that section 139A is very clear that if the NR has a business or profession which is more than 5 lakh in India, then technically they are required to obtain a PAN. But I have seen that still a lot of companies are giving a declaration they are not required to obtain a PAN, and people are accepting it on a practical level. But if you get into too much of technicality, you need to ask them show them the provisions which I'm talking about and say that why you are not covered here, please let me know. And probably they may not have an answer because the provision is very wide.
Okay, sure. Should we take the last question then?
Yes.
So it says, will loans or capital transactions be included to determine the 2 crore limit?
So no, it's a capital transaction that will not fall under service or property or goods, and hence it may not fall under the said limit.
Sure. I'll just answer a common question. I think at least 20 people have asked that will we get the webinar recording and the PDF? So yes, we will be uploading the session within 24 hours on www.taxsutrareservoir.com, which is Taxsutra's ebooks and e-learning platform. So for those of you who missed the session, you can just log on to taxsutrareservoir.com and view the recorded version of the session. With this, I would like to close the session. So I think Maulik, we had just blockbuster attendance today. I'm really sorry and apologize for those of you who got blocked out and couldn't attend. But I hope you could take the advantage of the YouTube live streaming that we had to enable, because the entire session was absolutely blocked and packed. So thank you so much, Maulik and Nishit, for this session. With 68 questions, such an amazing participation, and your razor sharp insights. I think it is safe to say it was truly a blockbuster. So thank you so much to both of you for putting this together for us.
Thank you, Tanaya. Thanks to all the participants. And if there are still questions unanswered, they can write to us and we'll try and answer them to the best of our abilities. Thank you so much.
Thank you. Bye.
Thank you.